Yeah, so investment properties require a minimum of 15% down. Difference between primary residence and second home, the primary difference is one thing we didn't talk about for first-time buyers, there is down payment assistance. So you don't always have to have a down payment available. Tell them, let's split that and buy two.
Yeah.
You get two deals.
You gotta use all your money to buy.
Yeah, don't put all your money,
all
your eggs in one basket. Let's get two baskets.
Yeah, right? You rent one and live in one.
Yeah.
See.
He's smart.
Yeah.
Sometimes he thinks he's too smart. I gotta knock him down a little bit.
Yeah. No. I just been doing it a long time. Buying sooner than later is going to benefit anybody because
Hi, welcome back to Realtors After Dark. I'm Sierra.
And I'm Todd, and I believe this is episode 5.
Five.
And we got a special guest today.
We have Jeff Shields. How are you?
I'm good. Hi, Sierra. Hi, Todd.
How's it going, Jeff? Thanks for being here.
Absolutely. Happy to be here.
So I've been utilizing Jeff's services for a while now. So we have different dynamics of buyers in our area. We have our first time home buyers. We have our seasoned want to upgrade home buyers. We have our second homes from California or snowbird country, things like that. And we have our investors. Breakdown, there's a lot of people that don't know the differences between all of those and the intricacies that you need to get qualified. So kind of give us an idea, a breakdown of what people are looking for when they want to get qualified.
Yeah, happy to.
Let's just say first-time homebuyer first.
Yeah,
Let's
sure.
start with that.
First-time home buyers just have to kind of be aware of credit score is pretty much one of the most important underwriting criterias, and your debt ratio. And your debt ratio is your amount of your debts in relation to your income.
Right. What score do they want to stay above?
Above 700 is going to get you pretty good interest rates. Some programs are more interest rate driven than others. FHA program, which is a first-time homebuyer program, is less credit score driven than some others, and they only require a minimum of a 580 score to put the smallest amount down. They will allow a score as low as 500, but you need to put 10% down when your score is beneath 580.
Which makes sense.
The FHA is pretty forgiving on their debt ratio requirements, so it's okay. Property type does matter. Like, it's kind of a collective scenario, so debt ratio, credit score, and property type all together will affect whether the loan gets approved through the automated underwriting system and then ultimately the physical underwriter. If the debt ratio is below like 40%, and it's in the 30s or low 30s, that's pretty favorable, so you could have a lower credit score and we might get an approval.
And this is why, in my opinion, it's very important that you want to get, like, if you have somebody reach out to you, hey, I want to buy, maybe I'm renting right now, and they think they want to buy, is to get them with a qualified lender.
Absolutely.
Because you don't want to waste the client's time by showing them houses, A, if they can't qualify for anything, B, if they don't qualify for a certain dollar amount, and you're looking at something that's above their price range, and they like all those features, but now they can't afford those features.
It's almost like letting their hopes up and then just to crash them afterwards, when if they just met with you to begin with, they could be on the road of, okay, this is what I need to get done here in order to be qualified. It just puts them in a better position where you're actually taking care of it.
And then if you do that and you don't qualify right now, he can put you on a roadmap to get there.
That's exactly
we can get there in a year or 6 months or whatever. Then they know, okay, I need to pay off these, I need to do this.
One of the misnomers or misinformation I feel like that's out there that a lot of clients will come to me and say, oh yeah, I have to, or I've been paying off my debt, or I've been doing this. You don't necessarily need to wait to get pre-qualified. Essentially, we go through the process. You might have to wait to make a purchase, But don't delay. I would encourage any first-time home buyer or anybody considering purchasing, don't delay having a conversation with the lender to see where you're at this moment. Even if your plan is not to buy for another 6 months, you at least know what you're facing now. And sometimes you don't have to pay off the debt that you think you do.
Right.
You may want to, so you have more cash to make a mortgage payment or feel more comfortable when you have a mortgage, but oftentimes you don't necessarily need to, because when you're figuring out the debt ratio or calculating the debt ratio, it doesn't matter what the total debt is, it only matters what the payment is. Some people feel like, oh, I've got $2,000 of credit card debt, I need to pay that off in order to qualify. Well, most of the time a credit card minimum payment on $2,000 is going to be around $50. And that doesn't affect your debt ratio very much, so it's not going to impact their qualifying significantly. Not all lenders are created equal, so if you spoke to somebody in the past and were declined, that doesn't mean you can't get qualified with someone else. Every lender is different, so Fannie Mae, FHA, Freddie Mac, VA, they publish their guidelines. But each company like us or a Wells Fargo or a Chase or any bank or any other mortgage company, we have the option of placing additional restrictions called overlays on their base guidelines. Cross Country doesn't put any overlays, or very, very few. We might have one or two. So that allows us to qualify as many people as possible.
Does their credit score get impacted by you doing a pre-qual on them?
Yes. If you do a hard pull or a soft pull. The soft pull we can do sometimes. I don't recommend it because there can be discrepancies between a soft pull and a hard pull. So if I pre-qualify you off of a soft pull today, and then you go shopping and find a house 3 weeks from now, and I do the hard pull at that time, it can be different, which could impact your qualifying.
Okay.
So,
what determines what's a soft and hard pull?
It's just the way we run it on the inside, and a soft pull will not affect your score at all.
Okay.
A hard pull will. I've been told by credit repair professionals that typically a mortgage credit pull will affect your score somewhere between 3 and 10 points. Typically, there can be other variances if the time I pull your report, you've done something else has changed on your report. That data goes together, at the same time, that could impact the score more, but most of the time, that's 3 to 10 points. And if I run your report today and the next reporting cycle, is next month, you'll get those points back in that next month, as long as you don't have any derogatory things that go on with your credit at that time. The other thing that buyers should be aware of or understand is that a few years back, the government said, we're not going to punish you for shopping for a mortgage. So if you've had your credit report run by one mortgage company, you have a 45-day period to look at other mortgage companies.
Oh, is that true?
Without having your score impacted more than one time.
That's great.
Yeah.
Okay.
Yeah.
That's really good. So it's very different than like getting a car loan. Where
Correct.
you go to a different car dealership
Correct.
and then they pull it again. It's like, oh shit.
Yeah.
You come out of there like, oh my God.
Damn car salesman. too.
No, you come out of there like, oh my God.
Yeah, I just lost 30 points.
Yeah.
Yeah, I've seen it.
Yeah.
Mm-hmm.
Oh my
That's
gosh.
crazy. So now let's shift into people that maybe want to buy another home. When I say another home, like
Move up
From
buyer.
one to an upgrade.
second
Yeah.
second stage home. I was always told under the thought is the 20% you gotta to do the PMI, but a lot of people don't have that 20% down. So talk about the differences in still having a conventional loan but having a 5% or a 10% down payment, and what the difference is other than the PMI.
Yeah, so if you have a smaller home, a starter home, a condominium, something like that, and you want to move to a bigger home, maybe you'll have some equity to bring with you from that property to make your next purchase. If it's not 20%, conventional, Fannie Mae, Freddie Mac allows a minimum of 5% down, and FHA's minimum is 3.5% down. The VA does offer 100% financing for veterans, so that's pretty cool.
Our VA's gotten better.
Yeah.
A lot better.
Yeah, and out here in Mohave Valley, the USDA is an option because USDA only works in rural neighborhoods. They don't consider Bullhead City or Fort Mohave a rural neighborhood any longer. Used to be.
Oh, okay.
And what is USDA? I mean, I've heard the term. I don't think I've ever had a client utilize it.
United States
the other
Department
day,
of
too.
Agricultural, so it's rural land, agricultural
We're in
land.
the boonies.
You can get financing from them, and they also offer 100% financing.
Oh, okay. Is
Where
that kind of the
Beverly
big? Is that kind of the big
Hillbillies
thing?
was.
Why people do that is 100% financing?
Yeah, Golden Valley and Kingman, parts of Kingman, not all of Kingman, parts of Kingman are still also USDA eligible. Yeah.
And then what about people that want to get a second home, a vacation home, so to speak?
Yeah.
What do those terms look like?
Or you can even talk about the client I sent to you and what's going on with that one, because that's a good example of a second home.
Yeah, so they were qualified to buy a primary residence in California. They're not finding something at a payment that they like. That's manageable, I guess, for them. So they decided they do want to retire here eventually. So they thought, well, maybe instead of buying it over in California, we'll just continue to rent here, but we'll buy a second home now that will turn into our retirement home later on. So difference between primary residence and second home, the primary difference is down payment. When you put less than 20% down on all loans, you're going to have, well, I shouldn't say all, majority of loans, especially Fannie Mae, Freddie Mac, FHA, you're going to have mortgage insurance. That was the way to allow less than 20%. Prior to mortgage insurance becoming a thing, you had to put 20% down. You couldn't buy a home unless you did. So this was the vehicle to make it work for lenders to take the risk of loaning more dollars. So in this case, they were talking roughly around a $300,000 price here because the cost of homes is less here. So it ends up being very close to the same down payment amount, just the percentage is different. So 10% of 300 is 30,000. Over there, they were looking at 3.5 of 900,000. That's 29K.
Right.
So it's about the
Can you
same.
imagine paying $3,500 in rent?
That's what we were paying.
Really? Hell no.
Yeah.
Okay, so now I guess the last but not least on the buying spectrum and is investment properties. We've done a lot of those for a client.
Yeah, so investment properties require a minimum of 15% down. If it's a investment manufactured purchase, it's going to require 30% down because there's very few lenders that are interested in,
It's a liability.
I guess they consider it.
Liability.
Yeah.
Manufactured homes have come a long way and they're going to continue to become more traditional and more, it's affordable housing. The U.S. is hurting for affordable housing. We're hurting for housing in general. We're 4.5 million homes underbuilt, coupled with we're already short of homes. So buying sooner than later is going to benefit anybody because as interest rates come down, which they're expected to this year, even if it's slowly, as they come down, you're going to bring more demand.
Oh yeah.
And then as more demand comes, if the supply doesn't change, you're going to have even less supply than we
We're going
already
to be
have.
back to COVID.
Yeah.
Ish. I don't think we'll be
Which is
that
not
crazy.
a bad thing for
Well,
realtors,
it's inflated. And then I was just talking to a client that Jeff and I are dealing with right now, and I told her, during COVID, an FHA deal, a VA deal, you didn't get a deal.
Wasn't getting
Cash or conventional, that's it. So we don't want to go back to that time because then we lose all of those buyers
Yeah.
that.
Which
okay.
is a
shame.
No, I can see that. Yeah.
So back to the investment question.
Oh yeah, we kind of went off track.
We went a little. 15% down is the minimum for site built home or condo 30% down if it's an investment manufactured home.
Explain what a site build is, because a lot of people have asked me the same question. I have to explain it to them, tell them what a site build is.
Site build is they bring all of the pieces and they assemble it at the site. They pour foundation, lumber, put it all together. Manufactured home is not technically site built because it's delivered on a trailer and then placed on the home. Nowadays, on a permanent foundation, the wheels and the axles are removed and it's placed on the permanent ground.
For all the young people, that was your grandmother's home
Yeah.
that you grew up with. Okay, go ahead. Sorry.
So that's the difference, a standard construction versus a manufactured home. Or there's another home category out there, a modular home, which is instead of the whole thing being delivered in a piece, it's delivered in pieces,
Sections.
one wall sections, like a puzzle, and it's put together at the site. In this area, we don't have a lot of modular homes, and neither in Southern California.
I've seen more of them come in.
Manufactured homes. It's, I don't even know what it is, July or June 15th.
June 15th of 1976.
And newer, you can typically lend on, and I know there's programs where you can do it prior, but let's just stay standard. That date, newer. And people will say, oh, well, what if I buy a 1978 this year? In 2 years, is that going to change and then I won't be able to sell it properly? Like, how set is that June 15th of 76 going forward?
Great question. That is always set because that is the date that the U.S. Department of Housing and Urban Development began, also known as HUD, began certifying those homes, or what used to be considered a trailer or a mobile home. They no longer, a mobile home was a vehicle. It was registered with the DMV. It is still registered with the DMV in a lot of cases. On June 15th of 76, HUD began to certify and engineer, the manufactured homes were engineered to meet specific standards so that they could be classified as real estate and as an actual home. That will not change. Everything built after that date has been certified by HUD.
Okay, that's cool.
Yeah.
Nice.
Yeah.
Very nice.
And yes, there are loan programs. I have options to help people purchase homes built before June 15th of 76. They're a little bit more expensive. The interest rates are a little bit higher for that, and the loan term is shorter. Maximum term on those is 25 years. With our program, there may be somebody else out there, but there's not a lot of investors lending on pre-76 homes.
It's going to be a little bit off topic, but if I'm coming to you and I'm saying, what is my proof of income? What do I need to show you in order to be qualified?
Sure.
What different methods do you have to qualify somebody off of their income?
If you're a W-2 employee for a company, you're just going to need a 2-year job history, and we evidence that with 2 W-2s and your most recent pay stub.
Okay, so W-2, 2 years.
Yep.
Okay.
If you are on commission or tips, then we need to average that part of your income over 2 years. So I always request your most recent pay stub and the last pay stub you received in the prior year. So December of 24 is what I'm asking for right now. That way it'll show me the year-to-date commissions that they earned, or bonus, or tips. So if you have variable type income like that, if your hours vary, like nurses, they typically have maybe a set schedule, but they get varying hours, or they have shift differential and different types of pay. All that stuff that varies has to be averaged. So
Independent contractor.
an independent contractor, a 1099 employee or subcontractor, they're considered self-employed. You need 2 years tax returns to document that. Or if they have 10% down,
Bank statement.
there is a couple other alternative documentation options, like qualifying off the cash flow of deposits on your bank statements. Or we have a program where we just look at your 1099. We don't look at your tax filing. We just look at the 1099 that you're provided by your employer. And then we come up with an income calculation based on that.
Got it. Got it.
When you're an independent contractor or self-employed,
which is a lot
of people, you have a lot of tax advantages to how you file your income, but sometimes that can hurt your qualifying. If you have never purchased a home before and you didn't get a lot of investment advice from your parents, like my parents never wanted to have investment property. We had a house, or they had a house, but they didn't want to buy rental property. I wanted to buy rental property, but I didn't know anything about it. It wasn't until I got into the business that I learned about it, and now I've bought in a few different rental properties.
Right.
But if you don't know anything, you know, we're here to help, so we can give some general information on those things. There are some investment property loans. There's a few loans out there that you don't have to have a job to get a mortgage to buy a property. And people are like, oh my gosh, we're going back to mortgage times before 2008. 2008 was the great financial meltdown,
right.
Mortgage crisis, whatever we want to refer to it as. Loans before that time were risky, were different. There was not a lot of regulation. There was regulation, but there wasn't a lot of like quality control on the loans that were being pushed in. So, for example, in the commercial world, there's a process they use to qualify someone buying a retail store or a rental property that has rental income on it, because it's not a personal asset; it's a business asset. Or business investment. It qualifies off the performance of the property. That's how commercial property works. It doesn't qualify off the individual that's purchasing it, because maybe it's not an individual, it might be a corporation. Right. So they've taken that theory and applied it to residential real estate or residential investment real estate, and you qualify off the performance of the property. So Todd's got a few clients we've done this loan for where the appraiser does a market rent survey and he says, okay, this home right now, the market is showing that it compares to other rentals in the neighborhood. This home's renting for $1,500. If your mortgage payment is $1,500 or less, it qualifies, you qualify, and you purchase that home.
Okay.
You don't have to have a job. You don't have to list the job.
Right. Just showing the projection for it, and that's how they get qualified, basically.
Yeah.
Okay.
He's smart.
Yeah.
Sometimes he thinks he's too smart, and I gotta knock him down a little bit.
Yeah. No. I just been doing it a long time, and I pay attention. I'm detail-oriented, analytical guy, and I feel awful if I tell somebody they're qualified and then the underwriter declines their loan. Like, I would feel awful. It doesn't happen because I'm very cautious when I do the pre-approval. Sometimes there's 1 year tax return option.
Oh, give us.
It kind of depends. If someone has been self-employed for at least 5 years, then you usually get the 1 year option.
Got it. Okay.
It's after I take the application and run the credit report and I run it through the automated underwriting system, it'll tell me on that report if we only need to provide 1 year or 2. And that could be an advantage. If we only have to provide, let's say, 2024's taxes, 2024 you made $100,000, in 2023 you made $50,000. When you do the 2 years, you have to average that together and add it together and divide by 24. Mm-hmm. If we don't have to use the second year, we use 100,000 from 24. Your average is higher, it allows you to qualify for more.
Right.
So that could be beneficial. One thing we didn't talk about for first-time buyers, there is down payment assistance. So you don't always have to have a down payment available. There's a couple different options out there. The state of Arizona has their own program. We are authorized to offer that product. Then we have a couple other national assistance programs that we provide as well. So Todd and I have a client now that is utilizing a national program. She may be able to use the state of Arizona's program.
On top of it, or
no, in addition to.
Okay, so you got to use one or the other.
Yeah, and they're slightly different. State of Arizona's one is not always available because of the way it's funded. This one, the national one, is always available, but you do have to repay it and you have to make a monthly payment on it. It's very small. Whereas the state of Arizona's, they have two different versions. One is a grant where you don't have to repay it. The other one is it's a silent loan, meaning there's no payments on it and no interest accruing, but you do pay it back if you refinance or sell within a certain period of time.
Oh, that's not too bad. That's not too bad at all.
Yeah. So.
And that's with 0%. 0%. You said interest.
Well.
Really?
Yeah. Yeah.
Oh my gosh. Is that okay? It's the grant.
There's a grant and then there's a loan with the state of Arizona. Sometimes
Okay,
one is available.
so
Others.
different time. Okay. Go
Yeah.
ahead. Yeah.
So, anyways, you can get your 3.5% down. FHA is usually what is utilized as the first mortgage with the down payment assistance paired with it. But through the state of Arizona, you can do a Fannie Mae loan with the assistance or a Freddie Mac loan with the assistance. Now, Fannie Mae offers and Freddie Mac, they both offer a 3% down option. That's your smallest down payment, technically speaking. But there's income limits and there's some other restrictions on there that it's not always available. You can't do it on a manufactured home either. But FHA always can be 3.5% down. So it's 0.5% more than that one, but it's always available. And the guidelines for FHA are a little bit more relaxed. They allow for a little bit higher debt ratio, and they're not as credit score driven. So if you have a little bit lower of a score, the FHA loan might work better for you. So far, from what I've seen for 2025 forecasts, all of the reports are indicating to price appreciation over the year. Some are like 3%, some are 6%, some are 5%, as kind of a nationwide average, and every market will be slightly different, but it looks like things are going to improve from a price perspective. So that's good for people that own homes already, not so great for people trying to get in, but all the more reason to look to purchase sooner than later.
Right.
And then as far as interest rates go, they are going to trickle down. Nobody knows how fast it's all market dependent.
So what do we think the interest rates are going to get to best case? I think it's probably going to be 5s.
I say just name it, and then if it happens, then you look like a genius, and everybody's gonna be.
I'm thinking by the end of the year we're going to be around 6, probably, possibly a little bit lower.
So what do you like to do for fun? I know you briefly said it before. Like when I can't get a hold of you, or when our future clients can't get a hold of you,
what the hell are you doing?
Which is like never. Like what? Yeah, what is going on? What do you like to do?
World.
Yeah, so we like to boat. We get on the river, get on the lake in the summer times. In the winter times, we get in the side-by-side.
Ah.
And it's crazy. So this guy, like, I go boating with him, side-by-side riding,
snowboarding.
What?
Yeah, and he's friggin' always on his phone. Like,
Always working.
Like if I was married to him, like his wife is a saint.
Yeah.
I would hate it.
She is a saint. I love Valerie very much. She puts up with a lot, but
Shout out to
fortunately she's in the mortgage industry as well, so she gets it.
Oh, that's actually a good thing though.
Yeah.
See, I gotta find a realtor.
Yeah.
That's my problem.
Yes.
Is there any single realtors out there? Hit me up.
Well, you can't act the way you do whenever you get hungry.
Right.
No one, they're just gonna look at you and be like, ugh.
Can't act hangry.
Yeah.
Betty White.
Yeah. They want a man that's like, oh yeah, I'm hungry, but like, I'm still gonna.
Jeff likes to golf too. He's not the best golfer.
No.
I like mini golfing. That's about it.
Really?
Mm-hmm.
That's cool.
I'd be a really good golfer though.
Get it in the clown's mouth.
Yeah.
Or the windmill.
Yeah. Or the pond.
No doubt. So we're gonna wrap this thing up, everybody.
We're gonna probably have him on again to discuss stuff more in detail.
Just want to thank everybody for your time. Hope you enjoyed the show and learned some information. I'm Jeff Shields with Cross Country Mortgage, Senior Mortgage Advisor, 949-584-4272. If you have questions, need information, I'm happy to help.
Look at that.
Very nice.
That's like a professional
Very
right
nice.
there.
I didn't look so that he didn't get shy. Okay.
Okay. Send us
All right,
out.
you guys. that is it for today's episode. Thank you, Jeff, for coming in, talking with us.
Appreciate it. Thanks everybody for tuning in to Realtors After Dark. Jeff Shields, thank you, buddy.
You're welcome.
As always, till next time. Thank you.